Good morning and welcome back to the Daily Hunt for Multibaggers, airing on Tuesday, April 14th, 2026. We've been sifting through a mountain of data collected yesterday, Monday, April 13th, and let me tell you, it's a lively day in the market.
Indeed, Ethan. We saw a significantly high volume of posts and discussions across a wide array of companies. While some names showed promising forward momentum driven by exciting news, others flagged some serious risk considerations. It's a very mixed sentiment out there, requiring careful analysis.
Absolutely. Today, our AI-generated insights really highlighted some interesting plays, from booming tech giants to some smaller, more speculative ventures. Let's jump right into it. First up, let's talk about Nebius Group, NBIS. The sentiment is truly buzzing around this AI darling. We saw discussions like covered calls gone wrong, crying, and got lucky on NBIS calls, showing a massive recent surge. The stock is up dramatically, with users lamenting they didn't get in more or celebrating huge gains. News headlines are touting its foray into full-stack AI and strategic deals, with Goldman Sachs even resetting price targets for 2026. This is pure growth potential, Brooke.
Well, Ethan, while the social media enthusiasm for NBIS is palpable, we have to look at the numbers. This stock is trading very close to its 52-week high, having jumped from $20 to over $150 in a year. That's incredible, but the price-to-earnings ratio is an astronomical 1,405, and its net profit margin is a razor-thin 0.19%, with negative operating margins and ROA. Insiders have also been net sellers of over 100,000 shares in the last 6 months. Previous readings have swung between stay away and speculative gamble frequently. This isn't just a high valuation, it's an extreme bet on future potential with very little current profitability to back it up. Based on our current analysis for Nebius Group, NBIS, we have to classify it as a stay away. The risk reward just isn't there for a prudent approach right now.
All right, fair enough on NBIS, Brooke. Next, we have Rocket Lab, RKLB. The community sentiment here is overwhelmingly bullish. CEO Peter Beck cutting his salary to $1 and canceling all his stock plans to align with shareholders? That's incredible conviction. Plus, they're filing for Neutron launch plans. Users are saying things like, "My only stock I am not scared about long term. Just keep buying and forget for a decade." The space sector is absolutely red hot, and RKLB is seen as a key vertically integrated player. This is a future multi-bagger in the making.
I appreciate the conviction, Ethan, and the CEO's move is certainly a powerful signal. But let's ground this in reality. Rocket Lab currently has a deeply negative net profit margin and negative EPS. Their debt-to-equity ratio is a concerning 15.395. While the Neutron launch has huge potential, it's also a significant capital expenditure, contributing to their current unprofitability. We've seen Rocket Lab mostly in the stay away or speculative gamble category in the past. While the future narrative is exciting, the present financial metrics suggest caution. For Rocket Lab, RKLB, our AI-generated insights suggest it's a stay away for now.
Okay, moving on to Occidental Petroleum, OXY. This is a fascinating one. While one user just bought $100,000 of OXY on a whim, the real kicker is that Warren Buffett holds it and insiders have been net purchasers of over 423,000 shares in the last 6 months. That's a huge vote of confidence from those who know the company best. Plus, with geopolitical events often impacting oil prices, there's always potential for an upside.
Ethan, while insider buying is a strong signal and Buffett's involvement is noteworthy, remember he bought it significantly cheaper. The price-to-earnings ratio for OXY is over 43, which is quite high for an energy company, especially with moderate revenue growth. The debt-to-equity ratio is very high at 63.8. Many users are pointing out that OXY stock doesn't correlate well with oil prices, often experiencing muted gains and sharp drops. Analysts are largely holding neutral or hold ratings. Our last rating for OXY was a buy back in March, but given these current red flags, we have to adjust. For Occidental Petroleum, OXY, it's a stay away.
All right, let's talk about Premium Catering, PC. There's a post circulating that NVIDIA is negotiating to buy a large PC-oriented company. This could be a huge game changer for a company like PC, a massive acquisition target for a tech giant like NVIDIA.
Ethan, let's pump the brakes on that one. While the headline is exciting, the company PC we're looking at, Premium Catering, has a market capitalization of only around $30 million. The community discussions about this NVIDIA rumor are focusing on much larger players like Dell or HP. Furthermore, premium catering's financial KPIs are deeply concerning. Negative revenue growth, profoundly negative net profit and operating margins, and an extremely high debt-to-equity ratio of almost 10. The stock also has historically very low trading volume. There's simply no indication that this PC is the target. Our previous ratings have consistently been stay away. For premium catering PC, it remains a definitive stay away. Now for some optimism. Let's talk about Intel, INTC. This looks like a genuine comeback story. We're seeing news of Intel joining Tesla's Terafab AI chip project and a landmark partnership with Google. Analysts like Northland Securities are raising price targets significantly, from $54 to $92, maintaining an outperform rating. And yes, insider buying is strong here too, over 483,000 net shares purchased. While past KPIs show some struggles, the market is clearly looking ahead at their AI and foundry ambitions. Our last rating was a cautious buy earlier this month. You're right, Ethan. The strategic pivots for Intel are genuinely compelling, and the insider confidence is a very positive sign, hinting at future improvements. The historical stock performance shows a strong rally recently, reacting to these forward-looking developments. While their past revenue growth and net profit margins have been negative, these new partnerships and their aggressive push into AI and foundry services are clearly designed to reverse those trends. This is a significant shift. Considering this fresh data and the clear catalysts, we are upgrading Intel. For Intel, INTC, we're classifying it as a buy.
Excellent. Moving on to another high flyer, SanDisk, SANDK. This stock is absolutely on fire. Users are celebrating massive gains with TSANDK posts everywhere, and some up 70 to 90% in just a couple of weeks. It's been added to the NASDAQ 100. Analysts are raising price targets to an astounding $1,800, and AI-driven NAND demand is pushing it to new heights. People are waiting for a stock split, anticipating even more growth. This is a multi-bagger in action. Our last rating was a stay away just a few days ago, but things are moving fast.
Ethan, the momentum for SanDisk is undeniable, and the revenue growth of over 61% is incredibly strong, validating the market's enthusiasm for AI-driven NAND demand. Insider buying is also present. However, we cannot ignore that with a price near its 52-week high and a price-to-book ratio of almost 14, it's a very expensive stock. Critically, SanDisk currently has a negative net profit margin and negative EPS. Investors are paying a huge premium purely on future growth expectations, not current profitability. While the news provides powerful catalysts for future profitability, entering at these valuations is high risk. However, given the overwhelming positive catalysts, especially the NASDAQ 100 inclusion and analyst upgrades, we're upgrading it to a buy from its recent stay-away rating. Just approach with caution.
And finally, we have Amazon, AMZN. This is a consistent winner. We're seeing Amazon expanding its use of Vuzix smart glasses for operational efficiency, making massive $200 billion investments in AI, and even expanding into the car sales business. CEO Andy Jassy is actively selling the Amazon AI story, and insiders have been net purchasers of over 1.1 million shares in the last 6 months. This company is a relentless innovation machine. It's consistently rated a buy.
I concur, Ethan. Amazon's consistent revenue growth and solid operating margins, combined with their strategic investments in AI and operational efficiency, make a strong case. The significant insider buying is a very powerful indicator of internal confidence in their diverse growth strategies. While the PE ratio of 33 is not low, it reflects the market's high expectations, which Amazon has historically delivered on. The smart glasses deployment in particular should boost those crucial operational efficiency KPIs. For Amazon AMZN, we confidently classify it as a buy.
All right, to wrap things up for today's deep dive, here's our compiled list for your further due diligence. Investigate as buy, Amazon.com AMZN, Intel Corporation INTC, SanDisk Corporation SNDK. Investigate as cautious buy, none. Investigate as speculative gamble, Rocket Lab Corporation, RKLB.
And that's all the time we have for today's episode of the Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in. We'll catch you next time on the Daily Hunt for Multibaggers.